Let's talk about entry points. We all think that we are trading from a great zone until the market tells us otherwise. No zone is completely certain to provide you with profit. However, it is common practice in retail to use confluences to increase a zone's odds in their favor. Yo, what is happening, traders? Thomas here from VAGAFX. In this video, we will cover the 3 biggest confluences that I use to take my trades. We will be covering volume, time, and structure, and you will find at the ends of the video how they all technically do tie in with volume. As we know, the market moves through the fulfillment of orders. So if you identify where the orders have been fulfilled, you'll also find where there likely still is unfulfilled orders as well, which can reject the market at a later point. As always, I do appreciate the support. Consider liking and subscribing. It is free, gets me out there, and you'll be blessed with good fortune over your next 10 trades. Now, a quick disclaimer that this video is going to be more helpful if you're a price action trader, or more specifically, a trader focused on supply and demand or smart money concepts. Now, the first thing that we are going to look at is structure. Structure is king in many strategies, as it's literally the embodiment of fulfilled orders in the market, giving us our bias of direction and also allowing us to see where turning points are made, giving us evidence of where orders are still going to be situated. The next confluence that we are going to look at when we're trading our zones is time. The Forex market moves through different time zones called sessions, and these are when different banks of the world are trading. Now, not surprisingly, certain sessions are far higher in volume than others, and therefore zones created during these sessions are more likely to contain higher amounts of unfulfilled orders to reject the market at a future date. Lastly, we need to be looking at the volume indicator. Now, you might be confused why I've brought this up last, as we've been clearly discussing volume in the last 2 points. This is because the Forex market is decentralized and the volume indicator is simulated based on tick data. So although it can be highly accurate, it does not always reliably indicate the true volume of the market. However, it can be a huge confluence to add to our chart, as it will allow us to confirm our zones that we have already theorized to have high volume, but also to allow us to find more opportunities from significant structure situated in lower volume sessions that may have had an anomalous spike in volume in tick data. So let's do some real life applications to the chart, guys, just so you can actually get a grip of what we've just covered in a live scenario. Now, obviously, this is back testing. I did actually get involved in this price action. You can actually see this through my Discord and Instagram. I do post my profits as well as my students' profits on these trades, as well as reels and content on those trades. But let's say that we're just waking up now on the dollar-yen chart around the London Open. We're 10 minutes before the London Open. We're going to have to mark out some structure just to gain a understanding of the direction of the market and what our bias should be for this day. Now, we're going to look at the top of the chart. We can see that this is the highest point of structure, and the highest point will always be a swing point, guys, and always obviously the lowest point, and that's just because this will be where the order flow shifted. We can see that there was higher highs being made and then lower lows being made. So this becomes a significant structure point. We're going to mark that out as a swing high. We're going to simply follow the market back. We can see that this is where the last order flow reversal happened. We can see highs being broken by here after lows previously being broken. So this is our last swing low. We can follow the market back. We can see this was the previous swing high. This was the previous swing low. So the market momentum is clearly bullish, guys. So we're going to see what happens now during the London Open. Now, we've had a breakdown, an order flow reversal, and there are going to be many traders, as this is the London Open, that are going to be trading from this zone that appears. We know that the momentum is bullish, and if you've been in trading for a while, you'll know that the trend is your friend. So you don't want to be trading from this zone. You know that the momentum is likely to continue to the upside. Now, you could look to trade this area by here or this area by here, and this is a good zone to have. We did actually draw this, and that's because it's situated during the London Open from the previous day. You'll find that the market didn't actually come back far enough into that. So we're going to keep playing price. You can see that anyone trading by here would have been taken out. The market proceeds to break and continue on its momentum. We then start to get into the US session, and then later on coming up into spread hours. That's the market rollover period. That's where the volume completely subsides from the market. We actually highlight these candles in yellow just because we know we want to ignore those entirely, and we do mark out the Asia session. You can see this by this red area appearing on the chart, and that's because it's normally low volume. Obviously this is the Asia session during the on the dollar yen chart, so it is on average higher volume. You'll find that the London and US open are still higher on average. We do start getting breakdown of structures, so we can see that there is a major low being broken by here. We can now confirm this as the swing high, or the new swing high. So this is the new swing high now that the market will likely target at a later time. We can also see this large amount of liquidity build up. We won't actually cover this today. I do go over it in previous lessons, and I will go over it in future lessons, but this is liquidity that the market will likely target. We can also see liquidity building by here, which will be inducement for our zone. Now we've got our latest swing high, guys. We're going to follow the market back and look for the last major order flow reversal. Now you can actually see that there is a small candle break by here, only it is a one candle break, not a two candle break. We do take this into account in our strategy. We continue the market back. We can see that there's a clear order flow reversal by here. That's major lows being broken, followed by major highs being broken. This is the lowest point. This becomes our swing low. So that's our significant structure sorted, guys. And now what else are we going to look at? We're going to look at time. We can see that this is the Asia session. We can see it's fairly low volume. It's higher in volume on average than other market pairs, such as the euro dollar, but it is still lower volume than the London Open. We can see the volume really picks up by here. This is where we get the market turnaround. So this is another confirmation that our zone is going to contain unfulfilled orders. We can see that there is imbalance here. Now this is unmitigated imbalance, guys. This is mitigated imbalance. On these older order blocks from previous days, we do actually use mitigated imbalance to draw our zone. If it was a fresh zone, we'd actually be looking to draw it from here. But as it's an older zone, we're going to draw our demand zone from here. So we've got our significant structure, we've got our volume, we've got our time. We know it's very likely that there is orders still unfulfilled at this area. The fulfilled orders is what caused this shift in order flow in the first place, and those BFIs that place the orders still likely have orders there. And also algorithmic bots may also target these levels as well as other BFIs. We can draw our entry point on the top of the demand zone. And you can also put your stop loss on the bottom at the swing low. You can have it slightly below. We can see that there will be a small amount of liquidity below here, although that liquidity has been swept slightly. So I would be comfortable putting my stop loss at the bottom on the swing low, and we can target the swing high as we know the momentum is bullish. We know that the market is likely to continue upwards. Get a sweep of this liquidity. The market comes down, and notice that the volume picks up at the London Open, guys, and this actually occurs during the London Open as well. We can see it. We get another rejection off this liquidity level, and then the market sweeps upwards, taking up the swing high and continuing long-term order flow. And just because it's the London Open, guys, and we're on the dollar yen, you'd think that European banks aren't trading. It's still an insanely high volume. If you open up your chart now, get the volume indicator up, you'll be able to see these high volume periods coming in during the US and European session. But this is also the dollar yen. This actually happened last week. I'll actually show the profits of this trade now, but let's just do the same thing. We're going to mark up the highest points. We can see that the market is clear trending upwards. We're going to mark up the highest point. We said this is where the order flow reversal happens. We can see that we had a break of this low by here. We follow the market back. We see that there's no lows being broken by here. We can see that there was a low broken by here, low broken by here, and then a high broken by here. So this simply becomes the last swing low. We can also see that this was a previous swing that was broken. So we know, guys, that the momentum is currently bullish. We can look to target this zone. We can see that this is a fairly high volume zone. This is actually the US Open. So we're going to draw a demand zone across. Now I'm going to draw the demand zone on this candle as well as the doji. We do use refined candles. You'll find that dojis sometimes don't get tagged, guys. That's just because markets are inefficient on lower time frames, and doji candles are pretty insignificant structure, so the market won't always pull back to these smaller candles like so. Now again, we can see a lot of liquidity building to the upside. And I did actually get into this trade, guys, and we did actually take a loss on this trade. You'll actually see that the market does actually reject. You do have time to actually lock in break even once we do start getting structure breaks to the upside. We can see that we have a break of structure here. So if you didn't take a loss on this trade, you could have got in break even. You'll actually find this demand zone actually does break down. But what we can do, guys, now that the market starts sweeping into this liquidity and this swing low, let me actually just get this. Once the swing low is actually broken, guys, we can change our bias. We know that this demand zone has failed. The market is likely now to reverse in momentum. We can actually follow the market back. We can see that there was a high broken by here, followed by breaks to the downside. So this actually becomes our latest swing point. We can draw this across. This is our swing high. We can actually see that the volume has come into the market. We can see fresh unmitigated imbalance. So it's as simple as just changing our bias with the market, drawing our supply zone, and we can look to get involved. Now, I actually did spot on this trade that we did have a large gap in the market. Now, a gap is simply imbalance that happens during market rollover, guys, but it does normally get filled. Normally imbalance gets filled. As we can see by here, the imbalance will get mitigated entirely for market continuation, and that's just because markets do imbalance and rebalance themselves. It's simply by nature. Markets are efficient, and that's because you still have these orders left at these zones unfulfilled, and it'll draw the market back like a magnet. We can actually see that the market comes up, tags this London Open supply zone, and then continues to the downside. So that is it from me, guys. I do post educational content on my Instagram 5 times a week, and I've started tweeting about trading related things, including what I'm invested into. I will put links to these socials in my description, and of course my course is available to purchase, and it does come with my premium community. My students are absolutely smashing it this week. I will catch you guys in the next one. Have a great week. Peace out.